Well, let's talk more now about what is going on not only in Egypt, not only in Tunisia, but also around the world, China even. It is food inflation, it is cost inflation, and it is what is going to impact developing markets. So says our next guest. He is here to join us. Jim Rickards is with us now, and we're pleased to have you, Jim. Thanks very much for being on the program.
Thank you, Brian.
I know that we had ostensibly asked you to come on to discuss China,
Sure.
and we will, but we cannot ignore what is happening in Egypt. There are reports also in Jordan. People are protesting over inflation. You and I spoke about it right before the show began. Where does this go, and what is the risk of higher prices mean for these types of economies?
Right. Well, in some ways, the China story, the Egypt story, and the Jordanian story, and actually inflation all around the world are all related. This starts with QE2, with Bernanke's policies. He's just been printing money, and he says, well, don't worry about it. We don't see any inflation in the United States. Well, maybe not, but all those dollars are going abroad. They're going abroad in two forms. Our trade deficit, which is everyone else's surplus, and so-called hot money. Investors get kind of zero-cost money from the Fed and from the banking system, and they invest it abroad. So the inflation is showing up everywhere else in the world: Brazil, Indonesia, Thailand, South Korea, China. Now, do you get, does Bernanke cause inflation in Egypt? Not exactly, but he's causing food inflation. Remember, these are world prices. The price of wheat in Egypt is the same as it is in Brazil or anywhere around the world. So it's like oil, natural gas, gold is one world price. So once you get these inflationary forces in play, it shows up everywhere. And the problem with the poorest people in the world, they have no margin for error. If I see inflation, I can buy some gold, I can buy some art.
Or you can just afford it.
Correct. Or you can either afford it or you can hedge yourself accordingly. But if you have no money and no savings and no investments, and you wake up and try to buy food and the price is up, that's the difference between maybe getting a meal and maybe starving. And that's one of the things that sets these things off. These riots, they have a lot of causes. There's a lot of frustration. There's a pro-democracy movement. There's an Al-Qaeda movement in the Muslim Brotherhood.
But you throw in the inflation you're discussing. You've got already political unrest. You've already got maybe a volatile situation.
Right.
Then you raise the price of foodstuffs by 20 or 30%.
Yeah. Well, dynamically, it's sort of like an avalanche. You know, when an avalanche starts, in theory, there's one little snowflake that causes the whole thing. You never find what snowflake it is, but then the village gets buried. And this is very similar, where all these stresses were there. You never know what's going to set it off. But food, what's more important than food prices? That could be exactly the kind of thing that
does this eventually take hold in China? We know the average income in China is about $4,400 US dollars per year. A couple $100 a month. That's it. If food inflation hits China, the people are going to be upset.
Right, that's a very good point. People forget. Now, I would draw the analogy to Tiananmen Square, the massacre in 1989. The Chinese leadership were confronted with something not unlike what's going on in Cairo today. It was a little more peaceful, but they went in with tanks and guns and killed thousands of people. Now, that ended up as a pro-democracy movement, but it started as an inflation protest because of food prices. It was peasants, it was workers, it was city dwellers, and it was others. And the Chinese are scared to death of inflation. One of the reasons they'll probably revalue the yuan upward is because they want to put a lid on the inflationary forces. But this is all coming from the Fed. This is having global implications.
We're exporting inflation.
Correct. We're exporting our inflation around the world. Now, the irony...
Maybe that's the plan.
Well, the irony is Bernanke actually wants inflation here because he wants to get this economy going. We have too much debt. We have unpayable debt. The only way to restructure the U.S. debt is to cause inflation, to make the real value of the debt go down. So Bernanke's printing all the money to cause inflation. The problem is it's going abroad. Those inflationary chickens are going to come home to roost, though. They're just about ready to show up on the U.S.
What does it mean, though? How do people are watching? They have stock investments, bond investments, gold investments. What do they do?
Well, you have to remember, the stock and bond investments, those are in nominal dollars. If I cheapen the value of the dollar, if the Dow Jones goes up 20%, but the dollar goes down 20% against gold, did you really make anything? You made some dollars, but what are the dollars worth? That's the problem.
The S&P priced in gold is gotten slaughtered.
Exactly. It's down, 90% in 10 years. So that's what people miss. So if you use the dollar as a numerator, you get, a counting mechanism, you get one result. If you use gold, you get a completely different result. And all these prices are actually collapsing when measured in ounces of gold, which is the real store value.
Jim Rickards of Tangent Capital. Jim, it was a pleasure. Thanks for rolling with the change.
Thank you, Brian.
Appreciate it. A lot going on.